If you're watching this video, you're probably either going through a divorce, thinking about one, or trying to help someone you care about navigate this incredibly challenging time. And here's what shocked me when I started researching the financial side of divorce. The biggest financial challenge doesn't come from the legal fees or even splitting assets. It comes from financial mistakes that happen because nobody explains the money side of divorce. As a CPA and financial planner, I've been diving deep into the financial realities of divorce. And what I've discovered is alarming. There are financial blind spots that can cost people tens of thousands of dollars, money they desperately need for their fresh start. I'm Toyin, and what I'm going to share with you today are the financial realities of divorce that nobody talks about in those initial lawyer meetings. These aren't legal issues, these are money management challenges that can either protect your financial future or destroy it. Because here's the truth. Divorce isn't just an emotional and legal process. It's a complete financial restructuring of your life. And if you don't understand the financial implications of decisions you're making, you can end up financially devastated, even with a fair settlement. But the good news, once you understand these financial realities, you can make decisions that protect your money and set you up for a secure future. The asset valuation that costs thousands. Let's start with something that sounds simple but isn't. Figuring out what your stuff is actually worth. Here's a scenario that happens more often than you think. A woman agrees to take the family home worth $600,000, while her husband takes his business and investments worth $600,000. Seems fair, right? But here's the problem. That business was valued using book value, which is basically what it costs to start, not what it's actually worth. The real value turns out to be over $900,000. That's a $150,000 mistake because nobody explained the difference between book value and fair market value. Here's what you need to know. Not all assets are valued the same way, and timing matters enormously. Real estate needs current appraisal, not purchase prices or online estimates. Research shows that there can be $50,000 differences between what people think their house is worth and what it actually appraises for. Business interests are even trickier. A professional practice, a partnership, even a small business. These need professional business valuations that consider goodwill, future earnings, and market conditions. Book value can be completely meaningless. And timing? Asset values need to reflect separation date, not current market conditions. If you separated 2 years ago and the stock market has gone up 30%, you don't get credit for that growth. It happened after separation. The financial lesson here, never agree to asset division without understanding what you're actually getting. Professional valuations cost money upfront, but save you from massive mistakes. The tax bomb nobody sees coming. Here's a financial reality that shocks people. Identical settlement amounts can have completely different after-tax values. Let me give you an example. Sarah gets $200,000 in RRSP assets. Mike gets $200,000 in non-registered investments. They think it is equal. But when Sarah withdraws that RRSP money, she'll pay taxes on every dollar. At a 35% tax rate, a $200,000 is really worth $130,000. Mike's investments, if they've grown, he only pays capital gains tax on the growth, maybe $10,000 in taxes total. That's a $60,000 difference on what looked like an equal split. Here's another tax trap. Transferring assets incorrectly can trigger immediate tax bills. RSPs can be transferred tax-free between divorcing spouses, but only with proper documentation. Get it wrong and you face automatic tax withholding. And the principal residence exemption, both spouses claiming it for the same property, is an audit waiting to happen. The financial planning lesson: always calculate after-tax values when comparing settlement options. What looks equal before taxes often isn't equal after taxes. The retirement security disaster. Let's talk about the financial mistake that destroys long-term security: misunderstanding retirement asset values. Pension values are particularly tricky. Your spouse's pension statement might show $400,000 in projected benefits. But the present value, what family law considers for division, might be $250,000 or $600,000. You can't know without professional calculation. Financial studies show that people regularly agree to give up pension rights worth $100,000 more than they realized because they used pension statements instead of actuarial valuations. Here's the financial reality: pensions are often the largest asset in a marriage, but they're also the most complex to value. The calculation considers your spouse's age, years of service, type of pension, and current interest rates. And there's another financial consideration most people miss: CPP credit splitting. You can split the CPP contributions made during your marriage, which can significantly impact your own retirement income. But you only have 36 months after divorce to apply. The financial planning takeaway: retirement assets require professional valuation and strategic thinking about your own retirement security. The support income reality check. Support payments, both spousal and child support, create complex financial planning challenges that most people don't anticipate. First, there's the income calculation challenge. If your spouse is self-employed or owns a business, their reported income might not reflect their actual ability to pay support. Research shows cases where someone claims $60,000 income, but has a lifestyle that suggests they're living on $120,000. From a financial planning perspective, you need to understand what income you can realistically expect to receive, not just what the guidelines suggest. But here's the bigger financial planning issue: support payments are uncertain income. They can be reduced if your ex-spouse's income drops. They can stop if they lose their job or become disabled. They end when children age out or if you remarry. This means you can't build your entire financial plan around support income. You need backup plans, emergency funds, and your own income sources. And here's a financial reality nobody talks about: enforcing support payments costs money. If your ex-spouse stops paying, you'll need legal help to collect, which means more legal fees. The financial lesson: treat support as supplementary income, not the foundation of your financial security. The insurance gap that destroys financial security. Here's a financial planning disaster that happens constantly: losing insurance coverage during divorce without proper replacement planning. When you divorce, you typically lose extended health benefits like dental and prescription coverage through your spouse's employer plan. Some provinces offer short-term continuation options, but they're limited and expensive. You need your own extended health coverage, and that costs money you might not have budgeted for. But the bigger issue is life insurance. If your ex-spouse is paying support, what happens if they die? The support payments stop, but your financial needs don't. From a financial planning perspective, you need life insurance on your ex-spouse to protect support payments. This should be part of your settlement negotiations, not an afterthought. And don't forget your own life insurance needs. If you have children depending on you, your insurance needs might have changed significantly. You're now a single parent with single income security needs. Disability insurance is crucial too. If you lose coverage through your spouse's employer plan, you need individual coverage. For someone earning $80,000, losing the ability to work could mean losing $50,000 plus in annual income. The financial planning lesson: insurance isn't just about protection, it's about maintaining your financial plan when life doesn't go according to plan. The cash flow crisis nobody prepares for. Let's talk about the immediate financial reality of divorce. It's expensive and it destroys your cash flow temporarily. Legal fees can easily reach $15,000 to $50,000 or more. You might need temporary housing. You're moving from shared expenses to individual expenses for everything: housing, utilities, insurance, groceries. But here's what really catches people off guard: single household expenses aren't half of married couple expenses. Research shows they're often 70 to 80% of your previous total household spending. You're duplicating fixed costs like housing, utilities, insurance. Food costs don't really decrease. Transportation costs might actually increase. Financial studies show women who thought they'd need $4,000 a month to live alone only to discover their actual costs were $6,000 a month. That's a $24,000 annual miscalculation. From a financial planning perspective, you need substantial cash reserves to get through the divorce process and transition period. If you don't have adequate emergency funds, you'd be forced to liquidate investments at potentially bad times or take on debt. The financial lesson: build cash reserves before and during divorce proceedings. This isn't the time to have all your money tied up in investments. The credit and debt financial nightmare. Here's a financial planning reality that destroys people's future borrowing ability. Joint debts don't disappear with divorce. Even if your divorce order says your ex-spouse is responsible for the joint credit card debt, you're still legally liable to the credit card company. If they don't pay, your credit gets damaged. Financial research shows women whose credit scores dropped from 750 to 550 because their ex-husbands stopped paying joint debts after divorce. This makes it harder and more expensive to get a mortgage, car loan, or even rent an apartment. From a financial planning perspective, you need to close all joint accounts, refinance joint loans to remove your name, and establish your own credit history as quickly as possible. But here's the challenge: if you've been out of the workforce or haven't had credits in your own name, building individual credit can be difficult. This is something to start working on before divorce proceedings, if possible. The financial lesson: your credit score is a crucial financial asset that needs protection during divorce. Look, I'm not going to pretend this is easy. Divorce is already emotionally exhausting. And now I'm telling you, there are all these financial landmines to navigate to. But here's why I'm sharing this with you. These financial challenges are manageable when you know about them ahead of time. It's the surprises that destroys people financially. The research shows that women who come out of divorce financially secure aren't necessarily the ones with the most money to begin with. They're the ones who understood the financial implications of their decisions and planned accordingly. You don't need to become a financial expert overnight, but you do need to understand that every decision in divorce has financial consequences: asset division, support arrangements, insurance coverage, debt responsibility. These aren't just legal issues, they're financial planning challenges. And you deserve to make these decisions with full understanding of what they mean for your financial future. If you're facing divorce or separation, I've created a free emergency fund calculator for real life. that helps you figure out exactly how much cash you need to get through this transition safely. It's designed specifically for women going through major life changes with realistic expense categories and Canadian considerations. Remember, you're not just surviving this divorce, you're building the foundation for your financial independence. And with the right information and planning, you can come out of this stronger and more financially secure than you've ever been. Your future self will thank you for taking care of the financial details now. See you in the next video.